Hi, I'm Eddie Sundergy, and welcome to Your Finance TV. It's a Friday, so that can mean only one thing. Jay Pelosky from TPW with his musings. How are you, Jay?
Pretty good, Marty. Thankful it's Friday, though. This is a real TGIF type of week for me. How about you?
I definitely feel that, Jay. I feel that TGIF feeling for sure. And I feel like it's been reflected in your musings. You know, the title this week is Testing Times, and it certainly has been a testing time these days in more ways than one. But how are you holding up, buddy?
Making it, right? Trying to do the best that we can. I mean, that's what the title this week was so easy, right? Because anybody who's been in the markets these last couple of weeks, couple of months, what have you, it's been challenging, right? There's been the equity chop back and forth. That's always brutal. You've had a massive sell off in treasuries, the worst sell off in the history of the US Treasury market. You've had 7 weekends in a row of rain here in New York City. So anybody who's in New York is like, what the heck? 7 weekends in a row of rain. Obviously, you have overhanging everything, what's transpiring in the Middle East and what's going on there with all the horrors that one sees and reads about. But, on the other hand, I also was reminded that yesterday was, I think, the 36th anniversary of the famous October 87 crash. And so I was that was early, obviously, hopefully, in my career. And I was there for that event. And I remember distinctly, like, looking at the Reuters machine. It was tucked away in a corner. Of course, we didn't have computers, tucked away in a corner, and it was spitting out the results. And, you know, just like dismal, right? I mean, like 20% plus decline in a day. And of course, I really didn't have any idea of what was going on, but I soon found out because, of course, 4 months later, it was my first job on Wall Street. 4 months later, the firm that I was working with shut its trading operation, and I was fired, unceremoniously, no notice, no 2 week vacation, just a goodbye. So, it's better than that, the environment we're in. And so, we're making it through.
Well, that's all we can do, right, Jay? We need to just keep on fighting. But what are your thoughts? You've been covering the markets for a long time. How are things looking?
Well, I think I give some examples in the musings. And one example is you have, on the one hand, a group like Phenom Group, which are guys I respect, Seth Golden, his team, talking about oversold NASDAQ, setting up a historical near-term bounce, perhaps the mother of all rallies. Okay, so that's one side. Then on the other side, you have Renmac, again, respected folks on Wall Street, talking about real yields closing in at 2.5%, which historically is where you get convexity with rates going higher above that. You have a more negative effect on the S&P. So that's, we're kind of finally poised or finally balanced between you can make a case for a big time rally. This is where Carson Group and others note this is exactly the time frame when for the last 10 pre-election years the market has bottomed literally to the day, yesterday, today, on average where the market bottoms before having a strong upward run into the end of the year. So that's what you're playing for if you're constructive, right? As we are. On the other hand, we also have CTAs being record short the U.S. Treasury market, betting on the Renmac story, right? That these real yields are going to cause something to break and markets are going to go significantly lower. So finally poised. And what's interesting, what I picked up on this week is that perhaps it's not going to be the direct relationship that tells us, that gives us the tell, right? It might be that the cross asset correlations are starting to break down. And so I noticed Bank of America put this out in the middle of the week that the positive correlation between investment grade spreads in the 10-year has dropped dramatically, right? So that's maybe a little bit where the fact that credit is still okay is starting to offset that rate back up. And then I think more importantly, they note that the negative correlation between rates and stocks has shifted dramatically in the last couple of weeks. And that's really important, right? If the weight of rising rates is becoming less heavy for stocks, that's a really good sign. Maybe it's a sign that the market's about to shift its focus to earnings, which again would be consistent with where we are in the cycle, and is typically one of those things that brings that year-end rally into play. So, and that maybe explains a day like today, right? Because I'm busy writing my musings, and of course, just before we hop on, I check the market, and I notice that rates are down. So, there's bond 10 years now, rallied about 8 basis points. So I'm like, okay, stocks should do fine. I check my other screen, stocks, everything's red. So maybe that's a sign that the correlations are breaking down, and we need to kind of focus on the earnings picture, and hopefully the Middle East does not become, more problematic. That seems to be the rationale for today's sell-off. But it's just another example of testing times. But within those testing times, starting to see some things that suggest we're maybe closer to the end of this testing period than the beginning.
So, Jay, these are obviously, as you say, they're testing times, right? And, when you're looking at markets, you kind of really need to get some structure around things. And you've always had like 4 guideposts that you kind of live by almost. Can you run us through those again and remind us about your 4 guideposts?
Yep. And the things that we really hang our hat on obviously shift over time. But we do have our process, right? It begins with the tripolar world framework, right? Our view that regional integration and regional deepening in Europe, Asia, and the Americas is what's driving the world forward. And then we have our global risk nexus that looks at climate, economics, politics, policy, and then how all those things dovetail into what it means for the markets, right? Those are set pieces that have been part of our firm from inception, right? Our name is TPW Advisory, Tripolar World. That's part of who we are. It distinguishes us, allows us to have a differentiated view on how things are unfolding around the world. Currently, and for the last couple months, we've had what we call our 4 guideposts to unlocking what we see as $1 trillion reward for stability, right? We believe we're on the path to stability. A year ago, we were talking about the middle path between high inflation and deep recession. Other people call it the soft landing. That seems to be materialized, right? Now we're focused as we get through the Fed cycle, as we get to the end of this rate backup, as we move forward, we think we're getting closer to stability, right? And of course, it doesn't seem that way, particularly given the Middle East, et cetera, but we believe we're on that path. And that $1 trillion reward I touched on, that's the $1 trillion plus money that has moved into U.S. money market funds during, over this volatile period, this year, 2023. So we believe there's a potential for a significant, what we call reward, if we reach stability, unlock that $1 trillion, and it goes back into risk assets. So that's the setup. Then what are the 4 guideposts, as you point out? The first is continued disinflation in the U.S. and Europe, right? We need to see inflation continuing to ebb lower to continue to convince the central banks that they're done tightening, which we believe they are. We think the Fed is done. We think the ECB is done. We think we're in the early stages of a rate cut cycle led by the emerging markets, okay? And we've already seen some of that, Chile, Brazil, Poland, others cutting rates. So we're in the early stages of that shift. The second is what we expect to see in terms of a global manufacturing recovery, right? So far, we've had this disjointed environment post-COVID where first it was all goods because people were in their house and they were buying goods, right? Then it was come out of the house, come out of COVID lockdown, go into services. And so we've had a real lengthy process of inventory destocking. And that obviously impedes on manufacturing, et cetera. So we're expecting a restocking process to get underway, already happening as auto production, auto parts, et cetera, all these things pick back up, notwithstanding the UAW strike, that we're going to have the PMI for manufacturing in the US, for example, break back above 50. It's been below 50, which is considered boom bust, for almost the last 2 years. So that's the manufacturing cycle we expect to see play out globally over the next 12 to 24 months. The third is earnings, right? Most important to stocks are earnings and cash flow, not rates, not GDP, not politics, earnings. And so, we've hung our hat on, again, what we've been talking about for the last year, high nominal growth, which supports the top line and thus reinforces a decent earnings outlook, right? Because remember, sales and profits are denominated in nominal dollars. So if you have high nominal growth, chances are you're going to have decent earnings. And that has supported the stock market and has allowed for multiple expansion. Going forward into 2024, and really we're focused on 2024 at this point, right? Markets are forward looking, focus on 24. Consensus earnings growth for the US is about 12%. If that materializes, then it's hard to see stocks taking a big hit lower, which is why we've continued to be constructive. We think growth is going to be fine, much as the Fed does, right? 1.5% to 2% real growth next year in the US. That should support earnings growth. That supports the market. And by the way, the rest of the world offers not only earnings growth, but valuation support, with virtually every major market trading at record or close to record valuation discounts versus the United States. That reinforces our appeal and our overweights in places like Japan, like Brazil, like China. Okay, so that brings us to the fourth and final guidepost, which is China. Believing that the policy mix in China is going to provide support for that economy to continue to grow. And China is just a great example of the current environment, Marty, right? Because Q3 GDP numbers came out Wednesday, I think, and they were better than expected, right? Better than expected quarter over quarter. I think consensus was something like 0.8 or 0.9, came in at 1.3% growth quarter over quarter. Better than expected year over year. Consensus 4.5, I think it came in at 5.2. And yet Wall Street Journal and others were just filled with, headlines about China approaching major, implosion and significant risks exist in China. So you have a really negative headline, and then you have better than expected data underneath. And that's the dichotomy, which leads to the confusion, which creates the testing times. But for us, the four signposts that we have identified, we feel that things are continuing to move in the direction of supporting that guidepost and that path to stability, which is what we're really looking for in 2024. We expect 2024 to be kind of a year where people recognize that we've kind of come through all the wash of COVID, post-COVID, inflation spike, Fed rate spike, et cetera, et cetera.
All very constructive, Jay. So, you've been obviously, as I said, you've been doing this for a while, and, you're a whippersnapper during the last crash. So, wrap it up for us. What do we do with our portfolios? What are your key takeaways for us to kind of how we should be looking at things?
Yeah, that's a great point, Monty, and a great question, because, we do offer two model portfolios here at TPW Advisory. One is our global multi-asset model, about 25 ETFs, benchmarked to ACWI, so global equities, global bonds, global commodities. So true multi-asset, true global. And then our second is our TPW 20, which is a thematic model focused on kind of the combination of future tech, climate mitigation, demographics, things of that nature. And so, we try to put all what we take away, all our global multi-asset work, and put it into those models, right? So yeah, that's our process. We talked about how we get to the conclusion. The models are how we express the conclusion. And so currently, in a nutshell, we believe the following: that the bond market repricing is close to being finished, and that as long as nothing is broken, that's a good thing, right? The bond market is much closer to reality today than it was a month or 2 months ago. Remember, bonds were big believers in the recession call, big believers that the Fed was going to cut rates later this year, beginning of next year. That's now been priced out of the market. That's a good thing, particularly if nothing is broken. And we just had bank earnings, right? Not only the big banks, but also the regional banks came in fine. There's no sign in the credit markets that things are breaking, right? High yield continues to significantly outperform treasuries in the US. So the Fed is happy to let these rising long-term rates do some of its work for it and tighten financial conditions. So we believe the Fed is done. The dollar has not been able to make additional headway, even with the 10-year approaching 5%. So very importantly for commodities and for non-US equity, we think the dollar is peaking and would expect as the rest of the world starts to pick up, as the US slows a little bit from the 3.5% to 4% growth that's likely to come out is Q3's growth, that the dollar will weaken relative to euro, yen, etc. These the euro and yen are both at like 30-year lows relative to the dollar. And the commodity picture remains robust, right? Our energy exposure has been a great place to be the last couple months. The earnings support our equity overweight. And we continue to be and have been deeply underweight fixed income and completely out of the US Treasury market. We were writing about the bear market in Treasuries 2 years ago. We've had no exposure to the Treasury market. Instead, we've been overweight credit. And as I just pointed out, high yield credit has done way better than Barclays Ag year to date, outperforming by like 900 basis points. And then finally, we believe China's recovery is for real. China, record low valuation versus the US, record foreign selling over the last couple months, economy picking up. So we continue to be constructive and overweight that market. And so that about sums it up, right? Overweight equities, underweight bonds. That's the big relative positioning on an asset allocation basis. Overweight commodities. Within those positions, overweight credit and fixed income, roughly balanced between US and non-US equities, and a nice position in emerging markets, both debt and equity. We think emerging markets are going to help lead the way out as we go forward into 2024, and we want to be exposed there as we are in both debt and equity.
That's great, Jay. Thank you very much for sharing your thoughts. And before we wrap, Jay, what are you doing this weekend? Is there anything on the telly of note?
There you go. Yes, indeed. Our Duke Blue Devils have a big game Saturday night, national TV. It's our third national TV game of the year. The last couple of years, we haven't had any. So this is new exposure for Duke. It's great exposure for the university, great exposure for the football program, which is doing so well, ranked 16th, 5-1 on the year, but facing a very talented fourth-ranked Florida State team on the road. So going to be a big test for our Blue Devils, but, like the markets, feeling pretty good about Duke's chances on Saturday night, Marty. Thanks for asking.
No, at all. Thanks, Jay, and thanks for sharing your thoughts. And obviously, all of our viewers, they not only got their portfolios positioned, but they've now got some entertainment on Saturday night, and great game to watch. So tune in here, tune in there. Jay, thanks again for sharing your thoughts. Appreciate it.
Right.
And thank you for watching. Good luck investing.